Hey everyone, welcome back to another episode of the Meet Kevin Show. Today, we have the honor and privilege of talking to the Director of Research, Brett Winton, over at ARK Invest. I'm super excited. We're going to talk about a whole range of topics from, of course, the Fed, inflation, wage price spirals. Of course, we'll talk about Zoom, and maybe we'll touch on Palantir and Roku, and of course, the future of innovation, hydrogen, electric vehicles, what's going on in Russia, you name it. We've got a lot to talk about. We've got an hour, so let's get into it. Brett, welcome aboard. The first question I have for you has to do with the Fed's big U-turn in December, which we learned about in their minutes on January 5th. They came out and U-turned entirely, telling us that inflation was no longer transitory, that we were heading into a disaster of broad-based inflation, more persistent inflation, suggesting that it might be necessary to have a faster runoff and a faster tightening cycle. What did you all make of this at ARK, especially since right after that we saw a continuation of valuation compression?
I mean, broadly, I think that it's evident to us that over reasonable time horizons, technology is massively deflationary, and that over time horizons that are consistent with our investment time horizon, that's going to manifest in basic cheaper products for consumers. And so I think there's a lot of commentary out there that thinks that the Fed is behind the curve. They look at, the Fed always has to overcorrect in order to stave off inflation. But if you look at the sources of that inflation, particularly early on, a lot of it was concentrated in the automotive sector, in both used and new car pricing. And we think that robo-taxis are going to price at equilibrium at 25 cents per mile. And so right now, when you buy a new car, you're paying 70 cents per mile for your transport. And so that's going to wreak all kinds of havoc on kind of both the new car pricing and used car pricing. Like, what good is an internal combustion engine used when you can literally travel cheaper by getting an Uber-like experience without a driver that tries to chatter at you? And so that's like one example, but across all the technology areas that we focus on, over the time horizon that those technologies are going to infiltrate the market, consumer goods are just going to get much cheaper. And so if anything, there are some downside risks to deflation, but I think that's over the course of the decade going to be more of what people are worried about and thinking about, rather than kind of like the supply chain disruptions that the Fed is responding to, in part because they politically have to respond to it to show that they're doing something. And then given what's happened in Ukraine, now, after everybody was falling all over themselves to say the Fed's going to tighten 8 or 9 times this year, now the Fed's likely to back off. And so, and then from a if you think about the game that we play, we try to play the weighing machine game, meaning people say in the short-term markets are voting machines, in the long-term they're weighing machines. Well, we try to underwrite positions and technologies over a time horizon that we think is consistent with an equity holding, which is 5 years plus. And the market has been really playing the voting machine game over the past 6 months. If you look at correlation of kind of innovation portfolios to where on the yield curve they're correlated, they've actually gotten much more short-term correlated, as in they're responding to that incremental Fed move, and they've lost their connection to the long end of the curve. But the weighing machine, like the discounted cash flow that you're getting, should be discounted by the long rate, not the short rate. And so it's clear that kind of like the marginal pricing is being driven by flows, not actual fundamental analysis, which is why we think innovation right now is on sale. That if you do good fundamental analysis of intangible assets over a reasonable time horizon, you can identify massive mispricings and then take advantage of those. So in some ways, it's a really great setup as far as we're concerned. Everybody that's been long innovation has gotten squished over the last 3 months. And so those are the puts and takes.
So you said valuing the intangibles. What's your process for that? I mean, like, for example, GM bought a Chevy Cruze, right? They've got the whole self-driving suite itself is probably worth, 40 or 50% of what GM is worth. Meanwhile, you got the CEO of GM and Ford, according to a Bloomberg article here recently, supposedly tightening supply chains on purpose to keep their margins high to squeeze more profit. How do you parse these things out?
Well, I mean, I think we have a framework we go through where we always start at the top down. We do careful work on cost declines in technology, and then unit economic cases of different buyers in different sectors as costs come down. And then at the individual company level, we go through and assess people management and culture and product leadership, the barriers to entry, where the company sits in the value chain, their ability to execute. And oftentimes, mature incumbent providers will talk a good game, and they may even make acquisitions. Cruise is an amazing technology. Don't get me wrong. I think there's questions about its scalability and their ability to manufacture scale the robo-taxis they need to extend that technology into commercial operation in a real breathy way. And marginally, as I understand it, what's happened inside GM is that the CEO of Cruise got forced out because the GM mothership wanted more control over that asset. And historically, an incumbent, a company with an incumbent's DNA, when they take more control over an innovative arm of the company, it does not lead to good things. Now, Kyle Voigt is back in charge. It was just announced today he's CEO of Cruise now, and I think he's really talented. And so, it's possible they'll be able to continue to aggressively pursue RoboTaxi, even within a more firm corporate embrace from GM. But the history would suggest that the company with old DNA is not going to successfully make the transition to a new innovation platform. It's
would
just
you think
very rare.
Is that true of like an Intel as well? Now they're trying to move the entire industry, the entire company from a hardware focus to a software focus. And the last earnings call, they didn't want to talk about Q4 earnings at all. All they wanted to talk about was their wonderful service transition. Do you have that kind of same feeling?
Yeah, I mean, Intel's interesting in that for one thing, they missed the transition to mobile, and you'd argue now they've missed the transition to AI as well. And so the company was on a real sustaining innovation path where it's like we can continue to try to pursue Moore's law scaling to deliver better computation per unit price to end users. And the miss on the transition to mobile was realizing that actually the more compute performance without paying attention to the power efficiency of that compute performance would not set you up to dominate a mobile platform. And then on the AI side, the parallel processing requirements for doing massive AI, they just haven't set themselves up for it. And so often with technology transitions, the vector that a technology is competing on runs orthogonal to the existing vector. And so the incumbent just can't wrap its head around how it needs to compete. And often it means they're misstaffed. I mean, back to GM and Ford, they now have finally recognized, hey, we need to invest literally billions of dollars in EV. This is not just a niche category. This is going to become the category. But they don't have the human capital to pivot to doing so. You need software engineers, not mechanical engineers. You need mechanical engineers, but the marginal important person is the software engineer, right? And so if you're dealing with software-defined vehicles, and you have and by the way, I'm a mechanical engineer by education, so I love mechanical engineers, but you need to have a workforce that is able to aggressively pursue the technology that is going to be the differentiating factor for your product or service, and they just don't have it. And so can you then effectively spend that billions of dollars that you realize you need to spend? Probably not. It's going to be very inefficient. You're going to hire lots of consultants. You're going to bring in BCG and McKinsey, and they're going to say, what do we do? And so then it's like you're setting cash on fire trying to make this transition. And then in the meantime, you have a big core, very expensive business running that you can't turn off because you're still trying to pay dividends out to shareholders. And so it's really messy and complex and hard to execute on. And so could they do it? It's possible. Would I bet on them doing it? Not really.
Possible versus probable, of course. Now, is
Yeah.
this why you think that, I'm assuming you think this, I don't want to put your words in your mouth, that you think GM's less likely to scale than Tesla, maybe because they have those software engineers, that vision-based guidance versus the map-based guidance, or is this sort of the similar wavelength of thought?
Well, okay, so there's two. Do you mean scale RoboTaxi or scale the EV business?
Let's do both, but let's start with robo-taxis because that's what I meant.
Sure.
Yep.
Yeah. So on RoboTaxi, I think there is a very real and pressing question that is if you think about Cruise's strategy, is we have a big HD map of the world, and we have very expensive sensors on our vehicle that we can have the vehicle be navigating through the world and match itself to where it is on that map in a really precise way. And so anything that deviates from what you see or what you sense on distance with their LiDAR and the map of the world, is something that's dynamic. It's something you need to pay attention to. And so that actually seems like philosophically a good way to go about solving the problem is you collect like a big, basically virtual map, and then you know exactly where your car is on it. And so then you know where you can drive and where you can't. The problem is that it doesn't scale very well, in that, for one thing, any given intersection on that map will change because there's road construction. There's all kinds of things that happen and probably change over the whole breadth of the map more frequently than you realize. And so then when your system encounters those changes, then the system performance degrades. And those changed circumstances are probably the hardest areas to drive. So a road construction site is harder than a normal road to drive. So your system degrades in the exact spot where you need your system to be most performative. And so if you're designing to like a performance condition where like you can't fall below some threshold, which is human driven performance, then you're better off designing yourself into the weak environment where you don't know anything or you know very little about the existing environment, and then having uniform performance across the environment. And so then that's Tesla's philosophy, is we should be able to drop our vehicle into any spot, and it should be able to, just based on visual information, figure out where is drivable and where is not, and how to follow the rules of the road. And so the problem with that is it's a really complicated and hard problem, and it's a problem that you need massive amounts of data to solve. And it's a problem that it might look like you're not making very much progress, but like the rocket ship, you're hopefully on this exponential slope going upward, as opposed to a slope that's asymptoting to some performance consideration. So, and it's also Tesla. It's not that Tesla doesn't use maps, and it may be that they need to use higher definition maps than they're using because they're routing. It's not like they're guessing where to drive. It's not like they are like wandering around like a rat in a maze, right? It's a question of how much information density do you need in those maps in order to perform. And so then in terms of scaling, not only are you potentially hit a performance constraint in any individual city if you're using the HD mapping approach, it also means it's very hard to go from one city to another city if you're using that HD mapping approach, because then you have to map that entire other city. And I know some implementations where literally mapping is not just HD mapping, it's like going in and manually telling the car where it needs to stop at a stop sign in order to get good sight lines to know if it can turn left. And so it could
who
be
does that?
It's not, I'm not sure I should disclose, but it was a startup that I respect and does really well. I mean, or had good performative technology.
Fine.
But
I had the short button ready,
Yeah, no, but think like, so it's not, I'm not even sure. It may be that they are operating then with more than just HD maps. It's HD maps that are heavily annotated, right? And human annotated in some way. And you can imagine that's how to get to market. That's what you might need to do, or what Cruise has decided you need to do. There is this intersection that our cars always have a problem with. Well, how are we going to solve that? Well, you can try to figure out how to solve it in a generalizable sense, but maybe it seems impossible to you. So then you say, listen, let's just like manually say the car should not proceed beyond this point without stopping and looking. And that would be a solution to the problem. And actually, that's a great solution. So you do it and it works, and you say, okay, we're just going to do that. But then that intersection changes slightly. And it's like, oh, they're failing in this intersection again. We have to change the stop point here. And soon you have to hire thousands of people to be like trying to like manually tweak the thing so it still works throughout the whole system. And so it just so your fail modes grow exponentially as you try to scale to different geographies. And so figuring out a way to design yourself out of that inefficient scaling is really challenging, and it could require you to not like to solve the problem in a narrow sense, because you are concentrating on the critical path to generally solving the problem. So I think that's, yeah.
That was really insightful. Thank you for that. So why, though, if you're going to drop the Tesla blind into an area and teach it to respond, why not equip it with a forward-facing LiDAR, just give it a little bit better edge? I mean, hey, yeah, humans, look, at night, I wouldn't mind having a LiDAR, some night vision. I mean, why not? It'll make it a little easier for me.
Well, I mean, it comes down to, like, would you rather have, Tesla selling 1 million cars a year or like 50,000, right? I mean, so the cost difference of yeah. Well, I think that there's you want to place a bet on the sensor suite you need to successfully commercially operate and not exceed that sensor suite because of the cost it will impose on the consumers of your vehicles and the subsequent limiting of your addressable market. And so, like, if anything, I would expect, well, who knows, given their recent commentary, but it's likely that once RoboTaxi is really working, the unit size and the upfront cost of vehicles continues to decline, much lower than people really understand. Because you would rather have, imagine if I'm calling a RoboTaxi and the RoboTaxi system knows if I'm trying to travel to like San Francisco or just like 2 miles away on city streets in LA. Well, then it'll dispatch to me the vehicle that's well suited to that drive, right? And so I don't need to build a vehicle that is highway spec to trundle people around for 2 mile trips. And in fact, it's probably going to be optimum for me to produce like little people pods that are neighborhood electric vehicles, because those will be lower cost to manufacture, and then I'll have an environment that's much more sensor penetrated, and so I'll have a higher volume of data feeds to continuously make my system better. And so there is a real, you need to have robust, kind of inexpensive assets to maximize the data capture or the data optionality that your system has, and that's what they've weighed. So, if they saw an advantage on an incremental basis of adding LiDAR to the system, I think they do so. I think it's, I agree with like Elon's take, which is basically like the road system is designed for a vision sensor. Like that's all of the every single design consideration made in the road system is, can this be operated by a thing that can see? And so if you have, so then like vision sensors should be, necessary and sufficient to deliver autonomous driving. And if you have to rely on some kind of like laser rangefinder that gives you the precision distance of a vehicle 300 yards out, like then you're actually over engineering your solution to the problem, and subsequently restricting kind of your actual path along critical path solutions.
That's very insightful. Thank you for that. Now, and I love the line "necessary and sufficient." I think that's so important because, like you said, it's got to be affordable. Otherwise, you're limiting your data anyway. And quite frankly, Tesla's autopilots, as we've seen through the data, safer than regular drivers anyway. Already, right? So I want to move to battery scale. So here's the thing: 90%, I think 90+% of lithium iron phosphate batteries are manufactured by China. The lithium cobalt ones, we've got much more dispersion here. Problem now with Russia and Ukraine is some of those supply chains are coming under question for lithium and cobalt. Sorry, not lithium and cobalt, cobalt and nickel. And there's this consideration of, if Tesla goes for these lithium iron phosphate batteries, maybe other manufacturers will follow. We'll go for these maybe cheaper batteries, maybe a little bit better thermal resistance, but are we now giving too much power to China? Sure, it's great for Tesla because they're close to CATL with their Shanghai factory, but when do we adapt in the United States? What companies are going to catch up? What are we going to do in Germany? Are we focusing on the 4680s, or do we just go with the cheap batteries for now?
Well, I think Tesla said that their standard range vehicles going forward will have iron batteries, and I don't know if Tesla would agree with this, but it seems likely to me that at least in the immediate term, marginal production of EVs is going to grow through the lithium iron phosphate stack. If you look at, so we've done cost declines on both cobalt batteries and lithium iron phosphate batteries, and lithium iron phosphate is actually a less mature technology in terms of production doubling. So kind of you for a marginal increase in lithium iron phosphate batteries, you actually get a higher percent cost decline than you do on the cobalt battery side. The problem
because it's less mature now.
Yeah, because it's less, because the production scaling hasn't happened there as to the same extent as it has for cobalt batteries. So the problem for other manufacturers, ex Tesla, is that their drivetrain systems aren't efficient enough to deliver a happy mileage range on those iron phosphate batteries. So Tesla has this vector by which they can continue to expand production that for now is closed off to other manufacturers. Is roughly my view. Now, insofar as I think any, you don't want to be single sourced to anybody or single geography in any kind of supply chain. Luckily, the lithium iron phosphate, it's not like the raw materials are scarce. So, you can go to Australia for iron, you can go lots of different places. And I would imagine that just like with the 4680 cells, as it's demonstrated that this is a viable mechanism for getting EV supply on the road, that other battery manufacturers will step in and begin to produce iron batteries. But I do think it's an interesting wrinkle right now because my sense is the other manufacturers they're like, okay, we're going to invest $10 billion in EVs. We need to lock up batteries. So then they go and try to lock up like cobalt supply out 5 years at a fixed price. And that seems like a way for them to de-risk the supply ramp, right? The problem is that then they're locking in a price on a battery stack that puts them in a much more expensive cost of the vehicle relative to someone who's being more agile and can switch to another battery chemistry. And so they may end up 4 years out, they're great, big push into EV plans playing out, and they're stuck at this massively higher cost structure. So they either are, profoundly unsuccessful financially for having done so, or Tesla is massively profitable because there's this huge price or cost umbrella that they're sitting under. So it's unclear to me that how the setup works out. If anything, so we have an expectation that 40 million EVs are going to be sold by 2026. The risk to that is definitely the exclusive of Tesla traditional OEM supply. Like now since we we said the same thing last year, where it's like the risk is the traditional OEMs and whether or not they're going to be able to ramp. From here to there, they have all announced massive CapEx plans. Like they've all basically pulled forward their targets. We're going to dump a ton of money on this, and it's still the risk, I think, because the execution it's really clear to me that they didn't actually believe it until at least 24 months ago, and it's not clear to me that they have the wherewithal to actually scale it in the way they want to.
Now, there are a lot of folks who say they would prefer to bet on commodities just because they look at the last 6-month charts and we see nickel, aluminum, all these commodities taking off. Is that a big mistake when, as you mentioned, a company like Tesla could just be agile? Why do I have to buy from you or even that material when I could use something else? Would that be a risk for betting on EV?
So when we do our forecasts, we look all across the value chain for what we think are good opportunities. So, and in part to de-risk the forecast. So, part of doing our EV forecasting is to look at, okay, let's look at the lithium, and the cobalt, and are there efficient investments there? Is there, what does the spot pricing look like? What is the cash cost to produce these materials? And with lithium, we did have investments in lithium companies for a period of time, and then the spot price got way out of whack to the actual cash cost to bring on more production, and so we took profits into a part of the value chain that we thought was going to, accrue significantly more cash over time. And so like within the commodity companies generally, so there's a difference, like trying to, if you're going to go out and, I don't know, buy yourself some raw lithium and keep it on your shelf, good luck to you. There's like some inventory problems there, but my experience with kind of commodity producers is that usually the executive teams make very poor capital allocation decisions right at the wrong point in the cycle. As in, it's kind of like this narrative infiltrates the market where, oh, the world is short lithium, and so then suddenly they try to roll up the whole industry or monopolize the market in some absurd way that ends up incinerating a lot of shareholder capital. That's not uniformly true, but it's it happens more often than you'd like it to. And generally, like our style is to look for kind of the real innovation enabling portions of the value chain. And like you said, it's like you could have 2 years ago looked at the landscape and been like, oh, cobalt's really in short supply. I'm going to go and like buy a Congolese cobalt miner, which there are a few. And there you're taking on a lot of like human rights issues, to be frank, and it's like there's a lot of de-risking you have to do to be comfortable putting money into that sort of investment. And then meanwhile, like I think suddenly the marginal demand for batteries is probably not going to come through cobalt, and Tesla recognizes it as like, is wildly innovative and is identifying all the choke points in its ability to scale and figuring out routes around them. And so if your bet is like, oh, there's this choke point that they can't get around, and so then that's where we're going to get like this massive return, you're at great risk of there being like a shortcut around your spot.
I mean, it's just basically like battery day, like you mentioned, cobalt shortage, and battery day, what do? New battery, a fraction of the cobalt needed.
Right, exactly. Incredible. And I mean, I think that I think you also have to be agile, like, or part of the reason, we look at the company's management and their product leadership is also trying to measure whether or not a company will be able to route around kind of the volatility that comes with the innovation strategic landscape. Things are so fluid, and there's a lot of kind of like ambiguity and uncertainty as to what the right pathway will be at any given point. So I think generally, like in some ways, the simplest way to put it, betting on like a raw material price inflation is in some ways betting against innovation, and that's the opposite of what we try to do.
That's a good point. Well, speaking about inflation, I've been reading a lot of earnings calls here, and it seems like almost anything that's customer facing, like Kimberly-Clark, Kraft Foods, insurance companies like Travelers, Progressive, Under Armour, Wingstop, Advanced Auto Parts, Home Depot, the banks, labor inflation, they're all complaining about freight, labor costs going up, and then of course part inflation, input cost inflation. Is it possible that if we keep seeing this, that we end up getting some form of wage price spiral, that even when our supply chains improve, we end up having inflation stay more persistent? And then the Fed needs to become substantially more aggressive, and we end up with sort of a mini Paul Volcker.
Yeah, I mean, I guess if you look at the underlying data, like consumers are coming back into the workforce. So there's not enough, I don't think there's enough tightness in labor markets right now to actually allow that to occur. There's a lot of people that kind of stepped away, probably on the basis that they've made all their life income in Dogecoin or something, that thought they were good, and then it is no longer worth nearly so much, and now the wages being offered are like a little more attractive, so they're coming back into the labor.
So you actually think this compression in stocks and maybe some alt investments could actually motivate people to come back into the workforce?
Yeah, I think so. I mean, if you think about, I think it was the Bank of America call where they talked about how their lower income customers, lower income, or I guess people that had $2,000 in their account now have $10,000 in their account. Or, I can't remember their exact phrasing, but it was basically like the lower dollar accounts had a lot more in savings than they ever have. And so I think generally, consumers got their stimulus checks. They stopped spending on services during the pandemic. And so then they had balances accrue. And some of them, invested it and did a lot better than they probably thought they were going to, and suddenly felt very rich, and then underperformed. And now they're like, oh, I guess that's not as much money as I thought it was. And it turns out I can't live off of that. And now I'm going out to restaurants again, which I wasn't before. So maybe I need to get a job. And I think that that's likely the way it will play out. I think over the medium term, the way we think about AI and automation and how it's going to play into labor markets is it's basically AI should be thought of as augmented intelligence, not artificial intelligence. And what it means is that it'll be, for a knowledge worker, you'll be basically amplify the power of that workforce. And so
productivity going up.
Yeah. Massive productivity gains. And so the marginal value of an employee might actually go up to an organization because, but the productivity they're delivering will go up even more. And so the net result is actually much higher GDP growth than people anticipate. And so on a, so it like implies, like if you deliver lots of GDP, then you can't end up with that wage price spiral because you're delivering much more in product to consumers.
Wow, that's incredible. So how long, though, until we see these sorts of improvements in potentially productivity?
But you can see, well, I think that there are issues with how productivity is measured in the GDP accounts. But like if you look at what OpenAI is really saying in the alpha code from DeepMind, these are just from a software engineering perspective, right? The alpha code example, this is an AI system that can take like written kind of programming problems and perform better than the median competitor in coding competition that is literally used to give people jobs.
Wow.
Right? And it's not like performance. So I talked to software engineers and they're like, we saw that and we were like, oh,
yeah.
Well,
uh-oh.
And so what it means is actually like the role of the software engineer needs to be like kind of higher level. It's like more of a
raises the bar
level. Yeah. Well, and it's like that software engineer can marshal the resources, can turn these coding AIs towards the problems that are most important for the organization to solve, and vet them and audit them and figure out how they puzzle piece together. So it's not that the job of software engineer will disappear, but the volume of effective code that's being produced will increase, right? And so the degree to which, think about the automation tools that we have right now. You probably use some automation tooling to run your global enterprise over there, right? It's pretty clunky, hard to stitch together. It frequently breaks. Like, it's really rudimentary if you think about it. And so like you as an enterprise of one or whatever, like you will become much more powerful, like much more efficient at like just getting to the interview than all of the stuff you have to do on the back end to promote yourself and everything else, right? And so like that will apply to every knowledge worker role across the economy. And so if Meet Kevin is putting out 20 YouTube videos a week as opposed to just 7, that's a massive productivity improvement. Maybe that's what you can do. Or you probably do more than 7 a week. I don't know how many you do. Right?
Well, thank you for that. Yeah, that's so. But I suppose this is incredible. I suppose it is possible though that companies might just say, "Geez, we used to need 50 engineers, now we just need 20." Isn't that a potential risk for some engineers as well? Just thinking separately from inflation now, of course.
Yeah. The history would suggest no, as in, so we looked at, for instance, after we looked at like automation and its impact on jobs. For one thing, it's always every technological like cycle and innovation, people basically claim that it's going to cause technological unemployment. So like if you look at the agriculture sector, you would think, well, introducing the tractor, gosh, that you need much fewer labor hours to work a field. So clearly that causes unemployment for all those agricultural workers. But instead, what actually happened is one, they shifted to other higher value jobs, and then two, the marginal labor hour being shrunk on in the agricultural workspace was not actually the hired hands. It was the owners of the farms who were doing essentially unpaid labor to make them happen. They were relying on, they're having 5 kids so that they had enough free farm hands to work the fields. Well, like the number of hours that those 5 kids had to work reduced because the tractors could do that work, but they still hired the same number of people. And so, but then there was massive economic production. And so, people moved into industry and everywhere else. And so,
sure, you grow capacity and everything.
Yeah. And so we take back to RoboTaxi, right? You would think RoboTaxi, gosh, this is self-driving cars. That's going to cause all these drivers to go out of business. Like somebody who's a professional driver, what job are you going to do once RoboTaxi takes over? Well, we actually think a widespread RoboTaxi system will create more driving jobs than it eliminates. Because think about who's driving today. It's 99% amateurs. You and I are amateur drivers, totally unpaid for doing so, right? But the marginal cost for us driving our own car is around 30 cents a mile. Even if we fully paid off the car and everything, just the cash cost, if you're driving internal combustion, is 30 cents a mile. Whereas RoboTaxi, we think at the margin is going to price at 25 cents. So literally you'll be saving yourself money by not driving the car that you have in your garage. And so a lot of those amateur driving hours are going to go to something where you're paying a RoboTaxi service for doing it. And that RoboTaxi service is going to have some back-end set of operators that are overseeing that system. So maybe it's false to call them drivers, but these are the people that in the event the system is a little confused, like Waymo has them now. Yeah. You press a button and somebody gets dialed up who like looks at the sensors and is like, oh, it needs to navigate here and like routes it around the problem that it has. And so the way in which we've done our estimates for the costs of that network is to assume that there's some human labor component that has to oversee it, that has to be basically like the monitor of that system. And because you're shifting so many miles from amateur drivers into actual market behavior, you create more jobs than even if you eliminate all of the current professional driving jobs in the US.
Wow. Yeah, just because now monetarily, it makes sense for you and I to just never bother getting behind a wheel again.
Exactly. And that's a lot of innovations actually work that way, where they take non-market activity and they turn it into market activity. So the introduction of the washing machine, right? What did the washing machine do? Well, a lot of housewives mainly were sitting at the scrub board and washing clothes every day. Well, they weren't paid for that. That doesn't show up in GDP statistics, right? But if you convert that into I'm buying a washing machine and then paying a service technician and paying the electricity cost of that washing machine, that shows up in GDP. And then that housewife, it has free time to join the labor force, which is mostly what they did. So you take like amateur washing and you turn it into professional washing with a machine. Now, if they could just make the stupid clothes folding machine, that would be even better, but that's aside, yes. And because I'm an amateur clothes folder and I'm not very good at it. So I definitely need a professional mechanism by which to do that.
You probably don't like it.
No, I don't. It's a lot of time. And so same with RoboTaxis. Like you have literally an hour a day that Americans spend driving, and you convert it into, and it's not captured. Like nobody recognizes that as economic loss, but it's a big economic loss. It's much bigger than kind of the loss from driving the vehicle, like the fuel cost. And you convert that into RoboTaxi. And then it gets recognized in GDP. And our view is it's going to be on an aggregate basis, I think it's a $26 trillion GDP creation event over 10 years. So measured against any technological transition in history, at least that McKinsey Global Institute looked at, this would be the biggest GDP productivity advance attributable to a single innovation, bigger than the steam engine, bigger than kind of the computers, and bigger than kind of automation in the manufacturing sector. Because we think it's going to concentrate in a pretty short time frame, and because it creates, it's basically like, we don't think you're going to pay for the full value of your time for using that RoboTaxi. Generally, consumers they pay roughly half to get their time back. But along the way, you go from being an amateur driver who's unpaid to paying somebody else to drive you very inexpensively and efficiently. And while you're sitting in the car, you can do other economic activities. So conceptually, I can work on, financial models. Realistically, I can watch, Narcos on Netflix, right? Either of those are GDP creation events. Either of those. One accrues to Netflix's benefit, the other accrues to ARK's benefit. But the net result on the back end is that you get the double whammy of GDP creation because you're paying for this platform that didn't exist before, and then you're freeing up my time to either also consume from another platform, Netflix, or do more work creating productive output for the overall economy.
One more contract written for real estate, one more whatever.
Exactly.
Interesting. So I want to ask you, some companies here recently have come out with guidance a little bit lower than expected for Q1, like Etsy, 10% lower guide. Amazon gave a lower guide. Zoom today gave a little bit of a lower guide. Is this, does a lot of this just have to do with Fed uncertainty? Does it have to do with war uncertainty? Or are we seeing a slowdown of the consumer? What's happening?
Well, I think that generally Wall Street and companies struggle with how to deal with very tough compares. So if you go a year ago, everybody was growing through the pandemic. So Zoom, Etsy, Amazon, they all had Zoom's was something like 340% growth that they're growing against. And next quarter, it's something like 100 and something percent growth that they're growing against. And so, the fact that these companies are growing at all after that huge adoption bump is a sign that you would, if it, we're clearly back to almost the normal times pandemic wise, right? And generally what happened to our adoption curves is it just pulled forward the model by some amount of time. And so the fact that it didn't pull forward the model with reverberations, but instead they're continuing to grow off the back end of that, I think is actually wildly bullish for the underlying technologies that are associated with it. So I think it's hard. It's hard to under stress, it's hard to the adoption surge that happened during the pandemic, and the fact that we're kind of okay, now we're quote unquote back. I mean, exception of the war going on aside. And that they're still growing on top of that, I think is actually a strong sign that the business models that they've set out and kind of the utility to the end consumer is very strong. So I don't know if I'd read that. I don't know if I'd read consumer weakness through those particular results. I think that it's certainly possible that the consumer as a whole is feeling marginally. I mean, I think the survey work suggests they really are feeling marginally more nervous here, and you could end up in some sort of recession based on either Fed over tightening or what the war is doing to the energy pricing landscape. I think that there's a lot of kind of macroeconomic reverberations that they have to feed through to the consumer in some point. I just don't know if those are the examples to look for to see that.
What odd or likelihood of recession in the next 12 months are you all pricing in? Elon Musk seems convinced there's going to be a recession this year. How did you all respond to that when you saw that?
Oh, I didn't see him say that, but I mean, I think it's, I mean, so maybe we independently came to that idea, but I don't know if I don't have a probability on a recession, and within our investing framework, it's not, since we invest in companies that we're underwriting over the course of more than just a single business cycle, it's not important to our investment process to necessarily know. Generally, we try to at the portfolio level, we, during risk off periods, we tend to concentrate the portfolio, and then as kind of you end up in risk on periods where the underlying securities appreciate substantially, then kind of we broaden the number of holdings in the portfolio. But that's not informed by necessarily hey, we're going into recession now versus not. I do think that there's strong evidence that the consumer doesn't feel comfortable right now, and it would seem reasonable to suggest that then they're going to pull back on spending, and so then that's going to take some of the edge off of the people's ideas about Fed tightening, but
Yeah.
yeah, I don't know.
But at that same time, I suppose if consumers do pull back, then it doesn't take much with these high comps, like you mentioned, for us to see GDP potentially turn negative for 2 quarters.
Yeah, I'd say 25%. Those are my odds.
Okay. The quote, by the way, just to get your reaction from it, was from December 30th. Elon Musk: predicting macroeconomics is challenging, to say the least. My gut feel is maybe around spring or summer 2022, but not later than 2023, in response to, when do you think the next recession will be?
Yeah, I mean, I agree with him also on macros being very hard to forecast. Like, I think, like, to me, it seems like the macroeconomic environment relative to what's happening in Ukraine, like the dispersion of potential outcomes here is very broad. I think we don't really know what the full set of ramifications coming out of that configuration are going to be. And the central bank moves are certainly unprecedented. I just don't, and like, So I think it's not that it's unforecastable. It's just I haven't done enough work to really forecast it.
Do you care about the 10-2 yield curve, or too manipulated?
Right, care? Well, I mean, I think one thing that's interesting is if you look at, and I mentioned it before, but the innovation portfolios have become much more correlated with the short end than the long end.
Right.
And if you look at the long end, it's actually come down. It's the 10-year is not up nearly as much as the front end of the curve, and the curve could invert. But if you're playing the weighing machine game, like you should be discounting cash flows at that long end. So I think that I wouldn't be surprised to see an inversion in the yield curve, and that would be a strong sign that we're entering or potentially tipping into a recession. I think that's like what could happen. In some ways, kind of what's happened in Ukraine, meaning then the Fed can be marginally looser, even though energy prices are up, because there's like a pointable reason for energy prices to be up.
Right.
Maybe reduces the risk to some degree, but it's really hard to call.
That makes sense.
Think that I do think that a thing that others who commented on that we strongly believe in is that all of the supply chain stuff, if you have a massively unprecedented supply chain kind of constriction, then you almost necessarily get massively unprecedented double ordering and call it misbehavior of companies that are trying to de-risk themselves against that supply chain thing. And that almost certainly gets massively overdone. And so then once it doesn't even have to be the whole thing unlocks, but certain portions of it can unlock. And then you end up with an inventory glut on business balance sheets in that particular area, and maybe even spilling onto the consumer balance sheet that can result in really choppy kind of performance results for businesses. So I think, again, it was the Bank of America call, maybe the Chase call. They were saying businesses were taking out loans specifically to hold higher inventories to protect themselves against the supply chain. Well, so borrowing against inventory and running intentionally higher inventory looks fine as long as prices are going up. But when suddenly it's like everything's on sale all at once, then you have big inventory write-downs that aren't great for your financial. So I think that's somewhere to come as well.
Yeah, that's very interesting. Because even recently, some folks are saying that, oh, well, maybe those inventories are in transit, but okay, fine, they'll show up eventually.
Exactly.
Even if it's taking longer, they're still coming. So,
right.
Okay. Right. So maybe rapid fire individual tickers here. Okay, you know this one's coming. Palantir, what happened?
Sure. I mean, like I described, as we're in risk-off periods, we tend to consolidate the portfolios. And so, we had some concerns about their competitive positioning within the government space and thought we had better risk money elsewhere. And so it's not, when you're making a decision to like consolidate a portfolio, it's not like those are easy decisions, but you look at kind of like the risk return profile for all of your positions and say what's lowest on the stack rank relative to something else that we think has comparable upside.
That makes sense. So in risk off periods, to make this simple, basically when prices are going down, narrow into the ones maybe you have the most conviction in. That's what you're saying?
Exactly. Yeah. Yeah. If we have a better edge somewhere else, then we'll operate somewhere else.
What did you think about their idea of investing into SPACs to the Palantir to basically try to VC partner with them and then get that software contract? Was this a little bit of a gimmick? Was that strategic? Or is the bigger focus on government and maybe their government activity not growing? Because that is something that stayed stagnant.
Yeah, I think for us it's more I think that they had a really differentiated product in government a few years ago, and then their competitive positioning has diminished, and then those government contracts, I think that they've shown a higher interest in multi-sourcing. So it's an interesting company. I think that the technology is super interesting. We're very bullish on AI generally. I think that the marginal competitive weakness on the government side just left us with other places to go.
That's fine. All right, let's move on from that one. Let's go to Roku. So I read the Roku earnings call. In the Roku earnings call, they talked about how competitive manufacturing TVs is and how complicated and frustrating it is for them to get their hands on chips. They got to spend more man hours or people hours, I should say, on chips to re-engineer them so they can use different chips in their TVs, complaining about, all the supply shortages, all the usual. They also said how TVs are a really incredibly low margin business and lamented that TVs are low margin and that their services are higher margin. Okay, good. But then like a day later, they came out and said, we're thinking about manufacturing TVs. What was your all's reaction to that? Because you have been increasing your position in Roku.
Generally, so Roku's an extremely interesting company from our perspective. The consumer cord cutting has, if anything, accelerated. It is likely that there is going to remain an advertising monetized kind of professional TV service, longish form TV service that exists in the new landscape. And we think Roku's extremely well positioned for that. On the TV side and the player side, you should think of that as like they are optimizing for customer acquisition in the most efficient way that they possibly can. So that's all, none of that side of their business is designed to, nor should it take high margins out. It's just a question of how efficiently can you acquire customers via partnering, via doing the individual sticks, whatever mechanism you need to do so.
Got it.
But ultimately, the pie that they're going for is that video service should monetize at some rate per hour of viewing. And so if you can drive, and in particular, advertising supported video should monetize at an exponential to how many total hours you can command of the overall advertising service landscape. So it's likely to us that there's not multiple winners in kind of the platform that delivers that advertising video service that is the alternative to old style linear TV, and that Roku is well positioned for that. And so what's interesting is like there's a conundrum for us where viewing hours of linear TV have dropped, but actually ad dollars, at least for the consulting agencies that track them, don't seem to have followed yet. So we don't know if they're being mismeasured now, or there's just like so much inertia and lag in the ad buying space that it is to come. So it seems obvious to us that the direction it's going to go is a service like Roku's. And also, if you think about what's happened with Apple and IDFA, where Apple's basically like thrown sand in the eyes of Facebook and everybody else, so they can no longer they can't tell that their ad delivers to an actual transaction at the end. This makes kind of Roku's product offering actually more interesting and attractive because they have an alternative mechanisms by which to track those consumers and can potentially compress right up against the actual transaction side of things within the context of their platform.
What about YouTube? Kathy has said before that Apple and Google are more like cash parks for her, but YouTube's crushing it. I mean, high margins, massive growth. Any thoughts on it?
Yeah, I mean, Alphabet is obviously an extremely successful and interesting company. I think that there is always a question within the Alphabet structure of how well they can incentivize people outside of core search to actually do aggressive work for the company. Like Waymo was ahead of the field in RoboTaxi, and I don't know if they've stopped making progress or they've just, they certainly haven't aggressively commercialized, right? And so they're either up against a technological barrier or they can't figure out how to motivate the talent to push. And they bought Nest, which is like an interesting product, and then they ripped all the software engineers out of it. And then, so I think their corporate strategy has been pretty sclerotic in terms of enabling other things outside of core search to actually work as good businesses. Now, YouTube is, a good business. It's super interesting. And it's a question of one, like, how much capital inefficiency is there inside of Alphabet, given kind of like those motivation concerns? And for us as managers, it's very easy for people to get exposure to Alphabet. There's all kinds of, Alphabet, like the FANGs are something like 40% of NASDAQ or something. And so, we look for intangible assets that are more misunderstood rather than something that, people are heavily focused on and probably understand more completely the value of the intangible assets they have.
Yeah, one of the themes of this talk that we've had, and thank you so much for it, is that you regularly talk about valuing intangibles specifically with a focus on human capital and management. I think nobody else really talks about that, but that's actually where the key and true value is. So I think you're hitting the nail on the head. Thank you for that.
Well, I think, it's two things, because we focus on basically, like the company's strategic positioning. How are they, is the management agile enough to get to the opportunity that we see on the horizon? And then we also quantify the opportunity. So every position we invest in, we have a 5-year price target that's based on not that I'm a technological optimist buying it at the end, but that I'm selling to somebody who's just buying for cash flow. As in, there's a massive multiple compression that's built into our forecast at the individual security level. And so I think that, there's a lot of value. And one of the things from the start of the firm that actually really surprised me is that the work that we were doing was not work that venture capitalists were doing. And it wasn't work like that consultants and stuff were doing. And so it was really evident to us, for instance, when Uber was raising money in private rounds at an extremely high valuation, where we couldn't underwrite the position given how much value it accrued when it IPO'd. Because, we do, and by the way, for now, it's the same with Airbnb, where it's hard, it's within our valuation framework, the intangible assets those companies have just isn't worth it. It doesn't deliver to us our compounded rate of return that we require.
Interesting.
And then you turn around, like having done that work, if it looks compelling, or I should say, it's only worth doing that work if you believe in the management team and kind of like the foundation that's inside the company that it can access that thing, right? And so our first screen at the security level is like, what is the people management culture? How is this a company that's in a product leadership position? How are they going to protect their margins or generate extra normal cash flow? Can they execute on this plan? And then if it qualifies on that basis, then we go through kind of the laborious process of underwriting and being like, well, then 5 years from now, what does this company look like if I'm a forced seller to somebody that doesn't believe in the things I believe in? And then if it, clears our hurdle rate of return, which is 15%, but now most of our positions are in fact, all of our positions are well above that, but 15% would be a rough doubling over 5 years. Then it's an interesting investable asset for us. But I think a lot of times there's two perceptions that people have that I think are wrong. One, you invest in unprofitable tech. Not true. 8 of our top 10 holdings are profitable. or at least on an operating earnings basis. And then one is about to be. So 7 out of the top 10 are profitable. And then the other 3 are in the genome space, where it's, if you're doing therapeutics, it's a whole different game. And then the other perception is kind of like, oh, you just invest in memes or the thing that everybody's talking about. No. What we do is we actually underwrite the things that people talk about. As in, we say, what is this actually going to be worth? Not, oh, this is a great idea, but what do I think is the financial value attributable to this? And so then that puts a cash flow generation number on the intangible assets that the company has. And so I think over a reasonable time horizon, we should be considered deep value investors. I'm buying intangible assets that are on market sale prices, in my view, right now. And waiting for the world to recognize the value of those assets. And so just like a value investor that's like, hey, I'm buying this way below book. Well, I'm buying these companies at way below tangible or intangible. And the challenge with it is that value is uncertain. And so and heavily uncertain. That's why these assets are so volatile, because when people believe the narrative, they say, oh, it must be worth infinite. And when they don't believe it, they say, hey, oh, it must be worth 0. Whereas I actually have a number, like, this is what it's going to be worth.
This is what it's worth. Wow.
Yeah. And so it's kind of the whole game.
I appreciate that. So we're essentially out of time. I want to give you a really quick rapid fire ones, like maybe 10-second reply if you can. Quick, and then we'll close it out here if that's all right. Enphase, high margin, competes with Tesla. You personally bullish, not financial advice.
You want me to give a 10-second answer? I think that the energy storage business is not the thing that I'm marginally interested in inside of Tesla, and so it's not the thing that I'm marginally interested in outside of Tesla. Okay. Electrons are electrons, and it's hard to. So it's hard to get margin on top of selling electrons.
Wow. Okay. If
an inverter company vertically integrated with battery and Bitcoin mining to provide a home solution for Bitcoin mining, I think that could be a really interesting carve-out position. And I think that's the solution that somebody needs to provide to the market.
Buy now, pay later. Innovative or not?
No.
Who's the Palantir competitor?
They're in the private space.
Okay, wait. Okay, this was actually another one. Private equity. Valuations in private equity haven't been coming down. Everything else is compressed. Why private equity?
What do you mean, why private equity?
Well, like, we haven't seen the correction, so to speak, right? Like,
why hasn't it happened? Yeah, there's huge inertia in private equity. Right now, they are able to go to institutions and be like, look, at our last 5 years, it's been amazing. And institutions are like, here, take all of my money, and then they're able to report out, on a very infrequent basis. It's like, look, everything goes up and to the right. It's like magic. There's no volatility here, and so people really like that they don't have to mark to market. People really like kind of like the historical performance. And so they have a huge bucket of cash that they need to deploy. And there's like actually a very narrow bandwidth channel in which to deploy it. And so it drives, and meanwhile, crossover funds and everybody else is getting in and being like, well, we underwrite positions in 24 hours. So, and it's going all the way down into the seed and Series A stage. And conceptually, there should be a lagged response where those valuations come down, or it could be that the public equity market, which is in the voting game right now, just isn't playing the weighting game. Like, how much does this intangible asset weigh? Very well, and that there will be an appreciation of it in the public equities to catch them back up to private equity valuations. I think the truth is somewhere in between, but there are, I think there. I have had clients say to me that I would really prefer your strategy if I didn't have to see the price every day.
Okay. All right. I appreciate that. Last 2 quick ones. Hydrogen, 2030s or 2020s?
2030s, if I have to pick one. I don't think it's a thing. I honestly don't.
Oh,
I think,
really? Okay, so bearish on it.
Yeah, I think that the cost declines you need in electrolysis just aren't going to get there. It doesn't make sense within at least consumer transportation within any reasonable time horizon. The cost declines in fuel cells aren't aggressive enough to catch up to EV, even if you assume that like something like the Toyota Mirai would sell at like Toyota Prius like levels for a decade, it still wouldn't be cost competitive. And if you're not going to drive it through the consumer transportation space, then you can't drive the volume you need to get costs down sufficiently. And if you can't get electrolysis cheap, you're just taking natural gas and converting it into hydrogen. So doesn't have the environmental benefit. So it's a really complex. Now there are niche applications where it works, and those probably grow over time, just not in the way that people were underwriting or believed.
So no Nikola. All right, we'll leave that one. Okay, very last thing. All in on, and this is a fun one. All in on NFTs or Ethereum?
Gosh. Well, see, I can't do these in 10 seconds. Listen,
it's the last question, okay? So
there are three simultaneous revolutions going on in crypto. There's the money revolution. Bitcoin is the winner. There's Bitcoin's going to win in money, so leave that aside.
Okay.
There's the DeFi revolution, which is basically like, imagine, a corporation might need like some interest rate swap or need some investment banking function from a structuring desk and investment bank. Well, DeFi, the reason they have to go to an investment bank is because Morgan Stanley's back there being like, or Goldman, like, our balance sheet protects this contract. It'll come good no matter what. You don't have to worry about underwriting counterparty risk because we have all of our reputation and balance sheet to ensure that this contract gets paid out as long as, and so that's why you go to them. Well, DeFi allows you to do that without needing the balance sheet because Ethereum or competing protocol serves as that assurance layer that means that the contract's going to come true. Okay, so Ethereum is clearly the leader in that space, but if I fast forwarded 10 years, would there be another way in which smart contracts were being prosecuted and executed? Maybe. I'm not like sure that that's like an institution that remains. And there's all kinds of trade-offs that people are writing smart contracts to Solana and so it's not totally clear that Ethereum is the winner there, but it probably is. And that's an interesting space. NFTs, they definitely are going to be functional within the consumer economy in a profoundly interesting way over the next decade. But the marginal NFT right now is probably not one of those things that's going to be interesting. And so I think there's just a lot of froth in that space. So I guess I'd go Ethereum if I had to choose. If you're throwing me into a random NFT, I mean, you might as well just light the money on fire, which I think our analyst in the NFT space has done numerous times. So, I'm not the expert. He's the expert, and he's like down a zillion %. So, but that's not to say it's not interesting. It's just not clear to me that, like, I think NFTs, probably the protocol level, or really like the wallet level is interesting. They're like, what OpenSea is doing is they're basically serving as the validation layer of what are valid NFTs. Well, then what do you need a decentralized protocol for if you're relying on them to validate? So anyway, I could go on for another half hour here. But,
well, I won't monetize your time. I already have taken you longer than you promised, and I appreciate you for that. Brett, this was absolutely amazing. Any last things that you want to say to the YouTube audience?
No, I think that the main message from us, and I think for everybody, and for you, Kevin, you who have, I think, sold out of and bought into like 50 positions based on your YouTube history over the last few years, is that if you're investing, you have to invest over a time horizon that makes sense. And you should actually do everything in your power to not mechanically limit that time horizon. You should have a low time preference. So what does that mean? It means don't like invest what you want to spend next year. Invest what you only want to spend 5 years from now or 10 years from now, and then invest in long-term assets because those are the ones that can most predictably appreciate over the long term. So that's like lower your time preference, people. And it's hard to do so because the information environment, promulgated by guys like you, Kevin, is actually like extremely short term. Yes,
it is.
And so, but the actual like duration that makes sense for you as a human is not for the next 3 months. It's for what are you doing with the next decade? And I think that So the way to successfully tap that, Schwab did a study. I think it was Schwab. I'm not sure. One of the brokerages. Who are our most successful traders on the platform? They looked at all of their accounts and it's like, who has done the best over the past, I don't know what time frame they looked it over. And they identified a subselection of accounts. It's like, what's unique about these people? The unique thing about them is that they'd forgotten they had accounts. So think about that. Like if you're better off like saying, this is something I'm going to invest in, and I either establish a purchasing program or I just like buy and forget that I bought it, you know. And if you need like cash next year, you shouldn't be investing that cash. You should keep it there. That's not investment advice. That's like practical life advice. Just, you know, every asset class is in some asset classes more than other, but it is volatile. And so think carefully about like if you're really investing or you're just having fun. And you can have fun, have your fun with your, you know, random ripping in and out of positions. But the kind of like long-term best interest of your financial health is to think with a long-term perspective.
So all in on the Russian ruble.
Good luck.
All right. Thank you so much. Everybody, please follow Brett on Twitter. Do you want to shout out your Twitter really quick?
Sure. I'm at Winton Arc. And then look at our Big Ideas report, which came out this year. We put a lot of work on it. Came out in January. It's at arc-invest.com. Big Ideas. And yeah, follow all of our analysts too. They're all great. So yeah.
Awesome. Well, Brett, stand by just for 1 second. Everybody else, thank you so much for being here. If you found the video helpful, consider sharing it. And until next time.